And then there is one most important thing within the cost of this is the site restoration provision. And this site restoration provision is also known as the dismantling cost. So the restoration cost, this is also known as the dismantling cost. This is also known as the decommissioning cost. Decommissioning cost. These are the names of a single cost: restoration, dismantling, and decommissioning. Now, what is the idea behind this? The idea behind this is, let's assume you have installed an asset, whatever asset it is, and you are required to dismantle it at the end of its useful life, at the end of its project, or on the completion of the project or the completion of the task. You are going to remove that asset, you are going to dismantle that asset, you are going to restore that site, you are going to decommission that thing at the end of its useful life, at the end of the project, on the completion of the project. And whenever you are going to do this, there will be a cost associated to that. There will be a cost associated to that. And that is going to be the future value. That is going to be the future value. Let's assume after 5 years, I'm going to dismantle this site, dismantle this asset. And after 5 years, I'm going to spend some money to dismantle it, to restore the site, to decommission it. The standard says that you cannot capitalize the future value itself. You are required to calculate the present value first. Now, present value equals to, now this is something which you have studied in your management accounting paper, but if, for example, if you have forgotten that thing, no worries, I'm going to revise it. So how the present value is being calculated, you take the future value and then you multiply it by 1 plus r raised to power minus n. R represents the rate of interest, which is going to be given in the exam question. N represent the number of years, how many years, after how many years you are going to dismantle it. So present value equals to future value multiply 1 plus r raised to power minus n. And you just need to calculate it on the calculator, and sometimes it is being given in the exam question. Now, this portion is being solved within the exam sometimes, but many times you're going to calculate it. So how you can do it? You have the scientific calculators, for example, or for example, you have the built-in calculator within your CBE system, CBD system. You take 1 plus r, for let's assume it is 10%, so you take that into decimal, 0.1, 1 plus 0.1. And raised to power is the exponent sign. You can see exponent sign. This is the exponent sign you can clearly see on the calculator. You need to press that. And then minus n, number of years, for example, 5, 10, whatever it is. It is going to give you 0. Something figure. You can just take, for example, 0.926, go up to 3 decimals. 0.926, 0.825, 0.728, things like that. You just take 3 decimals. So present value equals to future value 1 plus r raised to power minus n. And you know, when we are bringing the future value to the present value, this process is known as discounting. Be attentive. This is a very important thing, and you can expect that thing in the exam. So be attentive. So future value, when you're bringing it to the present value, this process is known as discounting. When you're bringing future value to the present value, this process is known as discounting. Now, the idea is that you have installed an asset, you're using an asset, and you're required either contractual obligation or legal obligation, whatever it is. You're required to dismantle it, you're required to decommission it, you're required to restore the site after a certain number of years. Then this cost is a direct cost because it is being incurred, it will be incurred due to this particular asset which you are using. So it's a direct cost. And we have studied that any direct cost should be capitalized. So because you're using it, and you have an obligation to dismantle it, then whatever the cost of that dismantling is, you need to make that cost part of the asset cost. So the double entry is going to be, now it is important to understand the double entry. The double entry is going to be debit cost, that means making that particular expenditure part of the asset cost, and credit provision for dismantling. Now, what is this provision for dismantling? It's actually a liability in the statement of financial position. Like after 5 years, you're going to dismantle it. So it's your obligation. And in the accounting terms, we call obligation as a liability. Now, why I'm not writing it as a liability directly, why I am calling it as a provision for dismantling. Like provision for dismantling means that provision is defined as a liability. Provision is a liability of uncertain timing and amount. Provision is a liability of uncertain timing and amount. I know that after a certain number of years, I'm going to dismantle it, but maybe I do not have the correct idea exactly how much I'm going to spend it, how much I'm going to spend on this dismantling. So it's the uncertain amount. That is why we call it as a provision. And now you know from your accounting concept that you are going to make an account for the provision. You're going to make an account for the provision. So what you're going to do, the provision account is being debited due to the asset. This is the opening figure, and this becomes your closing balance. And in the next year, this is going to be your opening balance. So this is the first step. This is the first step to calculate the present value. And then there is another thing attached to it, which is known as unwinding. That is something very important to understand. But let me show you an example where we are just calculating the first part of it. Okay, the first example, if an oil rig, okay, so if an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value of the cost of dismantling it. Like, and if you're building an oil rig, which is going to extract the oil from the sea, we see it in many countries, they're doing that. Not every country are having reserves within the sea, but the lucky countries are having that. Okay, so if an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value to dismantle it, because whenever you're extracting the oil, now it's your obligation to restore the site. You cannot leave that hole which we have made to extract the oil. You have to fix it. So if the cost of asset 10 million to construct, if the asset costs 10 million to construct and would cost 4 million to remove in 20 years, then the present value of this dismantling cost must be calculated. So you know the formula. I've already told you that if you need to calculate the present value, we take the future value 1 plus r raised to power minus n. Now the future value is 4 million, 40 lakh, 4 million. 1, 2, 3, 4, 5, 6, 6 zeros, right? 1 plus, now we need the interest rate. So it is being given. If interest rates were 5%, so, you know, in the decimal we take is 0.05, 0.05. 5 divided by 100, you get 0.05. Raised to power minus n, after how many years we are going to dismantle it? After 20 years, so we take minus 20. So first of all, as the maths rules states that, first of all, you need to solve the brackets. 1 plus 0.05. If you have the calculators, you can just check it. 1 plus 0.05, then press equal to sign. Then go to the above keys. You will find the exponent figure over there. Press this figure and then minus 20. So the present value of 40 lakh 4 million is 15,07,558. The future value of the obligation is 40 lakh, but we cannot record that figure right now because it is going to be a misleading thing. So what you're going to do is you're going to present value of that obligation, and then you're going to debit the asset with the present value of 15,07,558, and credit entry goes to the provision for dismantling. So this is at the start of the year. At the start of the year, and now you're going to make an account which is provision for dismantling. This is something very important thing. That's why I'm going to make an account for it. So provision for dismantling account is being debited due to the asset. You know how to put the entry into the account. This is a provision account which is going to be credit, and we give the reference of the debit entry in the account. So debit asset due to asset, and this is 1507558. This is the first concept which I've already told you, that how to calculate the present value. So we are done with the initial part of this dismantling, that we have successfully calculated the present value, and we have got the figure which is 15,07,558. Now we are going towards the next concept, which is known as the unwinding, and I need your attention for that. Unwinding. What is this concept? Now we know that the financial statements are being prepared for the user of the financial statement. We already know that the financial statements are being prepared for the users. We have already discussed this thing in the introductory lecture where we were doing the revision of the accounting when we talk about the financial statements. So the financial statements are being prepared for the users of the financial statement, and those users are concerned. For example, you're talking about the statement of financial position. They are being concerned regarding the assets which are being shown within the statement of financial position, that they are not overstated. And then they are also concerned regarding the liabilities as well, that those liabilities are not understated. So assets should not be overstated and liabilities should not be understated. And we have already discussed that this concept is known as the prudence concept. Prudence concept says that assets should not be overstated and liabilities should not be understated. This was the concept we have studied earlier. All are fine. So what has unwinding to do with this financial statement and the users? What is the link between this unwinding and the users? Now, the original liability is actually 4 million, which is going to be incurred after 20 years. Now, if we keep liability throughout 20 years at this 15,07,558, if we keep the liability at this figure for the remaining 20 years, then we are going to understate the liability. Because the liability is actually not the 15,07,550, it's the present value now. The actual amount you're going to pay after 40 years is 40 lakh, which is 4 million. So systematically, we have to take this present value to its original value. So what we will be doing, like we have used this 5% rate for the calculation of this 5%, for the calculation of the present value. We are going to take the same 5% to take it back to the original 4 million amount. Now, how that is being done? You're going to take this present value 15,07,558, and at the end of the first year, you're going to multiply it by 5%. This will give you the figure of 75,378. And what you're going to do, you're going to take 15,07,558 plus that's 5%, 75,378. At the end of the first year, this figure is going to be 15,82,936. Then again in the second year, by the end of the second year, you're going to multiply. This was the first year calculation. In the first year. In the second year, you're going to take again 15 lakh 82,936, and then you are going to add the 5% of it. Then it is going to give you the figure. Then again in the third year, whatever the figure is, you're going to multiply the 5% to it and then add that 5%. When you will be doing systematically this 5% thing, by the end of the 20 years, this figure will automatically reach 4 million or 40 lakh. So the first process was to bring the future value to the present value. This process is known as discounting. And then you are systematically taking the value to its original value. And every year liability is being increased by the same 5% which you used for calculating the present value. That same 5% is being added. And eventually after 20 years, this figure will reach 4 million. This process is known as the unwinding. Now the double entry to record the unwinding is debit profit or loss. And remember, this profit or loss is recorded in the statement of profit or loss as a finance cost, interest cost, because this is the same interest rate which you use for the calculation of the present value. Now you are taking it back to its original value. So you debit the profit or loss and credit provision. That provision is increased every year. So by the end of the year one, what is going to be the double entry? Debit profit or loss by 75,378 and credit provision for dismantling. So provision account is being debited due to the profit or loss, and the figure is 75,378. The closing balance in the year one, which is this closing balance is known as the liability because provision is a liability, 15,82,936. Which is going to be the opening balance of the year two, 15,82,936. Again, in the next year, you're going to take 5% and then add in it. Similarly, every year we'll be doing this activity, and this is known as the unwinding. So there are two things I'm going to recall. The first process is bringing the future value to the present value, known as the discounting. Initial double entry is going to be debit cost, credit provision. Make that present value part of the asset cost, and credit is the provision, which is the liability. Liability will be restated every year. And this process is known as unwinding. The double entry for unwinding is going to be debit profit or loss and credit provision. That means you're going to charge that interest expense within the profit or loss, and provision will be increased every year. Now, the important point to understand is that in the exam, examiner is going to ask you regarding the extracts of the financial statements. This is the most important thing. The calculation was easy. You just need to have the formula, and that's it. The extracts of the financial statements. Either the examiner is going to ask you what figure you are going to take within the statement of profit or loss, or they are going to ask you what figure you are going to take in the statement of financial position, or they can ask the both as well. So remember, in the statement of profit or loss, there will be two things. The first is the finance cost. And you know that this figure is actually the unwinding figure, debit profit or loss, the finance cost. The first figure is this, the finance cost, which we have calculated in the year one as 75,378, this figure. The second figure, which is going to be recorded within the statement of profit or loss, is the depreciation. Now, how the depreciation is being calculated? The cost of construction was 10 million, and then there was 15,07,558. Or you can say 1.507 million. You're going to add this thing, and it's going to give you 11 million something. And then you depreciate it over 20 years. This is going to be the figure you will be having in the exam. So for example, if in the exam only this cost of dismantling is being given, then you can depreciate only the cost of dismantling. If you have the cost of other construction as well, then you're going to club it and then depreciate it. So in the statement of profit and loss, there will be two things. The first thing is the finance cost, which is on the unwinding. And the second thing is going to be the depreciation. So you need to remember these two things. When they talk about the statement of financial position, they're going to ask the assets carrying amount, the carrying value. So we know that the carrying value is the cost minus its depreciation. So the carrying value is easy thing. When they ask you the carrying value, so you take the cost of asset and deduct the depreciation for the year, then you get the carrying value. Or they are going to ask you the provision amount. And remember, when they ask you for the provision, we are going to tell the closing balance to them. For example, if they're asking the closing balance of year one, this is the balance. If they're asking the closing balance of second year, you're going to tell them the closing balance of the second year. So be aware of the extracts, what they are asking in the exam. If they're asking what figure is going to be in the statement of profit and loss, then you're going to tell them the two figures or a club figure of that, aggregate figure of that, finance cost and the depreciation. Finance cost is on the unwinding. And then we have the depreciation, which is the cost of asset divided by its useful life. When they ask you regarding the statement of financial position, it is going to be either the assets carrying value, which is cost minus depreciation, or the provision, which is going to be the closing balance. We have another example, and then we are done with this dismantling concept. So an entity builds a research center in the rainforest at a cost of 2,50,000. This is the cost of constructing the rainforest. Having signed a contract with the local government to dismantle the center and restore the land after 10 years at an estimated cost of 100,000. So they're constructing a research center in the rainforest. And the cost of that research center in the rainforest is 2,50,000. And they're going to dismantle it as well once they're done with the project. And the cost of dismantling is going to be 100,000. Now we know the formula. We take the present value is future value 1 plus r raised to power minus n. Future value is 100,000. And 1 plus r interest rate is 5%, so it's 0.05, and minus n number of years are 10. So the present value of this is 61,391. So the initial entry is going to be debit asset because we are going to make this expenditure part of the asset cost, and credit provision because it's a liability of uncertain timing and amount. So we are going to make an account of the provision, and we know how to put the entry. Provision account is being credited due to the debit entry, which is the asset. So give the reference of the asset, and initially 61,391. So the total cost of the research center is going to be the building cost, which is 2,50,000 plus the restoration cost, and total cost is 311,391. And we know this 311,391 is going to be depreciated over 10 years. And this is going to be the depreciation figure. The second concept is that we have to restate the liability every year by using the same percentage which we use for discounting. So 61,000 multiplied by 5%, it gives you 3,070. And the double entry is you charge that thing as a finance cost within the profit or loss, and you increase the provision by that. So provision account is being credited due to the profit or loss, which is 3,070, and then you are going to get the closing balance of the provision, which is 61,391 plus 3,070.